Hey everyone, and welcome to this live stream. This is the 5,000 subscriber special. Um, thank you so much. This is the first time that I'm doing this, so I'm a little bit nervous. But thank you for being here. Okay, so I've got my coffee, and let's get started with the first question because I said, you can ask me anything. I don't know how long I'm going to run this live for, but thank you so far for the questions that's already been sent. The first one is from Vuisa. Sorry, I won't be available at 8 o'clock, but I'll watch live after work. Thank you so much. I wanted to ask, if I buy a house or a car cash, does that reduce your taxable personal income? So, unfortunately, not. The way it works in South Africa is when you buy a house or a car, there's no tax write-off like you get in the US. However, when you buy the house, it will have a base cost that you can use. So when you eventually sell the property, you will pay less capital gains tax because of what you bought the property for. Also, the same thing if you buy a car cash, it doesn't reduce your personal income for tax purposes. What does reduce your taxable income for tax purposes is, for example, if you have something like a retirement annuity, the retirement annuity will definitely help you to pay less tax. Also, if you have medical aid, your medical aid tax credits can give you a tax refund. If you are earning things like rental income and you've got expenses that can be deducted against that, that will obviously reduce your taxable income. Also, a pension or a provident fund through your employer, those are all things that can reduce your personal taxable income. And also donations. Okay, so if you have tax deductible donations, you can deduct those. Hello, Select Young Company. Welcome to the live stream. Thank you for being here. So I hope that answers your question, Vuisa. Okay, let's go. Terence, my friend Terence. By the way, this is Rich Ideas, Terence. That's where I got this mug from. If I have a PTY Ltd, that is a private company, if I sell shares to my staff, is this considered a disposable, or is this considered a disposal, and is it taxable? So before I carry on, I just want to check, is the sound fine? Because I see there's about nine people online currently watching. I just want to check, is the sound fine? You can, okay, perfect. To answer Terence's question, okay, if you sell shares to your staff, what happens is basically there isn't a tax effect immediately when you sell the shares to your staff. However, there will be a period of holding. So Section 8C, capital C of the Income Tax Act, there will be a restriction as to when the shares will vest into the employee, which means that when they can actually exercise the option to sell the shares, or to maybe they end their employment after 5 years, then they exercise the share options, and then they have to pay normal income tax on that. But the initial selling the shares to your staff does not have an immediate tax implication. However, what I would advise is definitely speak to your accountant / tax practitioner and make sure that that they're aware of this the share options that you do want to give to your employees, because the structure can get a bit complicated. I hope that answers your question. Okay, Mike, are there any fees or tax implications for moving tax-free your tax-free savings account from one bank account to another broker, such as Easy Equities. So there isn't any tax implications when you move from one tax-free provider to another tax-free provider. That's not, and also tax-free savings accounts do not have tax implications unless there are foreign holdings inside the tax-free savings account. So if you are earning foreign interest or foreign dividends, there will be tax on that, but there won't be a local tax, or there won't be tax on your local interest and your local dividends and any capital gains tax that might arise. But there's no tax between transferring your tax-free from one place to another place. Okay, Royal Mickey asks, what are your thoughts on EC10? My understanding on EC10, if I quickly look at that, EC10, I did a little bit of homework. It's basically the EC10, for those who don't know, EC10 is basically like an index that gathers up a few of their favorite cryptocurrencies, and there's a company, I think it's called DCX10.com. So you guys can look at it. I'm just going to type that here, DCX10.com for EC10. Okay. So that is where you can buy into the index, and basically it's trying to say that there will be that it's an index fund holding only cryptocurrency. So if you're interested in investing in cryptocurrency, what a lot of people do is they either buy one coin, or they buy a set of coins. So that might be Bitcoin, Ethereum, there might be Dogecoin in there, Litecoin, or they might go and only invest in one coin, for example. I'm not an investor, an investment advisor or a financial advisor, so I can't specifically give you advice, but I think EC10, it's not a bad idea to include crypto in your investment portfolio. Some people say 2%, some people say 5% of your portfolio, some people say 10%. Now 10% sounds a bit risky to me, but I like EC10. I'm considering adding it potentially going forward. It just depends on how this year goes financially, but yeah, I like EC10. I don't think it's a bad idea. And I know Mike Jordan is like I think he's the CEO or one of the main guys at DCX10.com. So yeah, check them out. Okay, let me see. Mr. Lebeko, Mr. or Mrs. Lebeko, excuse me. Good day. Do you do tax returns for businesses? My dad is in business a few years behind, trying to get him sorted out for this financial year. What do I need to do before I approach a tax practitioner? I think the important thing would be to ask your dad whether there was any financial statements done for the company. If not, my recommendation then is to download the bank statements from whichever bank the company is at, so that you have those bank statements. And then obviously when you approach a tax practitioner, the important thing is you must feel like you are learning something from them. At least in the meeting, they want to hear your story. They want to hear what the company is about, and then they can actually start doing the work. I don't personally do really the tax returns for companies. The reason is I am not an accountant. Oftentimes a tax practitioner works in combination with an accountant, because an accountant needs to sign off on the financial statements, and then those financial statements are then used to do the tax returns. with regards to the tax returns of a company, if there aren't any financial statements, then you can easily just submit dormant company tax returns. If there was no if there was no trading or any trading done, then you can submit dormant tax returns without financial statements. Okay, let me see. Next question. Can we do a step-by-step guide for ITR 14? We can. We can certainly do a step-by-step guide, or I can do one. My schedule is just a bit hectic with regards to actually making videos, so I'm going to make an updated video of the dormant tax return. I did one about a year ago, but it's getting a bit outdated with the new e-filing, and so definitely a guide on doing the ITR 14. It's very complicated because unlike an individual tax return, has a set rule. So you tick you tick what you need, your RP5, your medical, your RA, you tick what applies to you, and then you do that. But for a company, the bigger the financial statements, the numbers, the bigger the balance sheet, the more, I mean, I've seen a 15-page company tax return up to 23 pages. So it can get really, really, really complicated. But I believe a lot of small business tax returns, ITR 14s, are not that complicated and can be done. So I can definitely make a tutorial on that. One thing I'm considering, if I do another live stream, I might actually try and share my screen, find out how to do that, so that I can actually do a live tutorial on an ITR 14. So I'll plan that. Okay, it's Lebeko again with no question. Thank you so much. If you can get a car allowance and have a fleet card to use on the car for the job, and they increase your tax based on your spending on fleet purchases, do I get a tax refund from SARS? Okay, if you get a car allowance, the other name for it is a travel allowance, or it could be a use of motor vehicle. So a travel allowance is when a company pays you money, and then you can use that money to buy you a car, which you use for business travel. Use of motor vehicle is the other fringe benefit, which is when it's the company that provides the car, and you also get a payment for that. The big thing there is you must have a logbook, and the logbook, depending on your business kilometers that you travel, that will determine whether you're going to get a deduction against the travel allowance. The deduction will get you a tax refund, definitely. That's one of the reasons why people have travel allowances, so that they can claim the kilometers, the business kilometers that they're doing. Listen, guys, just a side note. You are welcome to ask non-tax related questions. This is a celebration of hitting 5,000 subscribers. Yeah, I've got a guitar there. I've got a baby. I can talk about nearly anything, but happy to talk about tax on a Sunday evening. Thank you so much for being here. Right. Brandon asks, can you not pay tax from working internationally without going through the financial immigration process? Well, Brandon, good news. The financial immigration process completely stopped. The 1st of March 2021, you no longer have to do the financial immigration process. And so now you actually just have to apply for immigration on, you can actually just apply on SARS e-filing through the tax clearance to say that you're immigrating. You don't need to submit any documents through the bank and through SARB, which you would, in the past, you would need to submit your financial immigration documents via the South African Reserve Bank to the bank, and then the bank sends it to you, and then you send it to SARS, but now you don't have to do that. Now, if you work international, the legislation has changed. If you are earning more than 1.25 million per tax year outside of South Africa, but you are a tax resident in South Africa, then you're going to pay tax in South Africa on the amount that's more than 1.25 million. What do I mean by that? If you're earning 1.25, if you're earning 1.5 million, then 250,000 will be more than the 1.25 million, and then that amount will actually be taxable in South Africa. And that would be taxed at your applicable tax rate, which means that you will already be at the 41/45% tax bracket. So you're going to still pay quite a bit of tax on that, even if you meet the requirements. But the financial immigration process actually fell away, so that's good news for you, Brandon. Reina asks, I'm in the UK, paying tax here, but I'm an SA citizen. What are my tax implications? Interesting. Okay. One thing to clear up very quickly with everyone, you cannot be tax resident in more than one country. You can have a dual citizenship, so you can be both a UK citizen and a South African citizen at the same time. So the citizenship and residency does not mean the same thing. That's a very clear difference. To answer your question, if you are working in the UK and you are meeting the Section 1010 requirements, which means that you are outside of SA for more than 183 days for the year, part of that 183 days, 60 of that is consecutive, then the first 1.25 million will be exempt from SA tax. Any amount more than 1.25 million will be taxed in SA. Now, did the 1.25 million actually change? The foreign income exemption. 1.25, 1.5. Yeah, it's still 1.25. Okay, good. I'm not wrong. That's good. Okay, so the amount over 1.25 million will be taxed in SA at your particular tax rate. So that's a big one. Oh, but remember, if you've got income on top and then the exemption of 1.25 comes down, then your taxable income goes down to 200 something. So if that's your only income, then you're going to pay tax at the rate of 200,000. Excuse for that mess up. Sure. 21 people was watching. Goodness me. I thought there was only going to be one person watching. All right. Will there be updated legislation for people working from home? What's the best way to rent a property for your business, but also live there? Okay, Bernard. Thank you so much for the question. At this point, yes, the working from home legislation is very limiting, in that if a normal employee works from home, You can only claim a portion of your rent. You can also only claim depreciation, and you can claim some water and electricity. And the other issue is it must be you must have a letter from your employer which says that you mainly work from home, or that you can mainly work from home, and the office space that you have must be a dedicated office space. In the past, SARS have actually asked for proof, or like a photo where they ask to send a picture of your dedicated office space. Even I'm in my living room, so I can't claim home office expenses. I just can't, because my desk is literally in my in my living room. If you're self-employed, in that case, if you're self-employed, or you're a freelancer, or you're a contractor, or you're mainly a commission earner, then you can deduct all your trade expenses. So, but still, you must have a demarcated office area. And also, with regards to that office area, if it's your own house, then that portion that you use for business purposes will be excluded when you sell the house. That's important. So keep that in mind. There was a second part of your question. What's the best way to rent a property for your business but also live there? I'm not too sure. I mean, if you are renting a property for your business, you can obviously deduct the rent that you pay against the income. But if you also live there, I don't know how that will change things. Just make sure that your landlord is happy with the arrangement. Koshik asks, I'd like to disappear to a tax haven. Any advice would be massively appreciated. I mean, that's a simple one. All you need to do is you need to leave. You need to leave South Africa permanently. Listen, if you don't want to be caught into the tax net, I do have a bit of a stupid video that I made. It's the 3,000 subscriber special. And some people did not find it very funny. It's my most disliked video on YouTube. Normally I don't get any dislikes. But that video has like 23 dislikes. Any case, if you don't want to, if you actually don't want to pay any tax, what you need to do is you need to become a non-resident, or at least not pay any tax in South Africa. Is you need to become a non-resident in South Africa. I just did an opinion letter for a friend of mine who left SA permanently. He's living and working in the UAE, but he's going to remain there indefinitely. So 5-10 years. He moved his family. Basically, he moved his whole tax structure outside of SA. So when you do that, you leave the tax net of SA. And so obviously then you don't pay tax. They only recently introduced VAT in the UAE, as far as I can remember, but otherwise he doesn't pay any tax there. And the other important thing is you can't just pack up and leave, and or tell your practitioner or tell SARS, no, I'm leaving SA. Number one, you must have the intention to leave permanently, which means that you leave with the intent of not coming back. Now, your non-residency can change from one tax year to the next, but your intent must be to stay outside of SA, and so you establish a new home. So firstly, you must have intent, and then you must establish proof of intent. Have you moved? Has your family moved with you overseas? Have you established a new business, or have you found permanent work in that particular country? Those are all things that show SARS that you actually have proven that you're going to stay outside of SA and not fall into the tax net. So that answers the question for Koshik. That's how you would leave SA to a tax haven. Besides, besides reciting tax from your sleep, what else do you do? Any hobbies? I do play guitar. I've got a guitar there. Let me quickly. So I do play guitar. This is just a little tune. My baby is supposed to sleep, but I'm just gonna do this one quickly. Okay, and we're back. Yeah, so I mean, I play guitar. I love cooking. Tonight I made quite a big fish meal. There's fish and there's some potato, whole potato, peas with broccoli. It's a nice mix. And there's also like a mayonnaise paste or something that I made. Yeah. So I love cooking, and I love also I like writing. So there might be a tax book coming out. I don't find a lot of time to write it, but that is in the works. And then also I do social media. I love Twitter. Twitter is literally the place that I hang out. And yeah, Twitter, YouTube. And then a big thing is I'm part of Banker X. So Banker X is a website with a bunch of articles, lifestyle. It's about ETFs. We joke there. I write about tax. We've got a very good core team. Koshik is on there. We've got. Let me actually get the team here, because this is going to be a shameful plug. So I hope you guys don't mind. So it's myself, it's Koshik. We've got Wogan, who's like the IT guy there. We've got Harsha, that's very good at business and marketing and things like that. We've got Vusi, who does property. We've got Wahid. He does investments and machine learning. So he's got an interesting thing there. We've got Clyde Shetty, Andre, and Jonathan Piens. They are both financial planners, and then we've got Caleb Schruter, who is a car enthusiast and a car salesman. So I write for Banker X, and that's the core team there. So that's for the hobbies. Okay, let's get back to the tax stuff. I want to cash in my Forex trading gains. What are my tax implications? Okay. Well, Forex trading is literally, it's a lot of homework, to be honest. You must track all your currency purchases. Obviously, I hope you do. I hope you're doing that. Then you must track all your Forex sales, and you do that on a monthly basis. And then you have to tally all that up. Now, remember, if you are trading Forex, there will be spot rates for when you purchased the dollar and when you sold the dollar, and hopefully made a profit there. And then whatever profit you made over those 12 years must be tallied up, and then you are going to pay tax on the on basically the profit. If you are using anything to generate the forex trading income, maybe you're using a computer, maybe you are using specific software that you pay monthly for, you have internet, so you can deduct those costs against the forex income, because it is a trade, it's a legitimate trade. But yeah, so, and you would pay normal income tax. What do I mean by normal income tax? Normal income tax is you've got the tax rates that floats between 18 to 45%, and then wherever you land on that scale, you're going to pay tax on. My general rule of thumb is when you have any type of business as a sole proprietor, a good idea is to set aside about 10 to 20% of your income or of your sales aside for taxes. Another side rule to that is, if you have a sole proprietor like that, have a separate bank account, Capitec or whatever bank, Standard Bank, FNB, whichever bank you like. Open a separate bank account in which you put the tax that you've set aside, so that when you're supposed to pay the tax, the money is there. Because often what happens when you run your own business, whether you run a rental property or you do Forex stuff, whatever business you have, a lot of people forget to put aside taxes or money for taxes, and then they can't pay SARS. So that's really important. You have to set aside the money, and then you must be able to pay SARS, because then you'll find yourself in a bit of a pickle. Brandon asks, anyway, a company you know of who helps retired old people do their tax filing? Well, Brandon, I definitely do help people do their tax. I've marketed myself or my services on Twitter. I'm going to leave my email address here. So if you guys want to contact me for consulting or a tax gig, just let me know. That's my email address. So that should be very helpful. All right, Leroy. Good evening, Andre. Good evening, Leroy. If my Bitcoin wallet has increased in value and I decide to spend it at an online company that accepts Bitcoin as payment, bid or buy or whatever, what are the tax implications, if there is any? Okay, I'm working currently on a video about cryptocurrencies. So to answer your question immediately, when you've got a value, whether it's on exchange or a wallet, and it increases, there is no tax on the increase. Similar to if I hold a share and it increases in value, I don't pay any tax on the increase in value. You would pay tax when you do something with that. So for example, when you trigger a type of disposal, if this was a trade, if you are regularly trading your coins, then there obviously will be then you'll be considered a Bitcoin trader or cryptocurrency trader, and then you'll be taxed as if you're a share trader. However, if you are investing in a particular coin, Bitcoin, Dogecoin, whatever it might be, you hold it over the long term and then you sell, that will trigger capital gains tax. Now, you're specifically asking if I decide to spend it on an online company. The problem I think that SARS will have, and this is, you bring up a good question. I mean, this is a simple question. Um, if SARS can't answer you, I can't. So what happens is, when you sell, if you don't bring it into fiat, into the rand, and then you buy on bid or buy, when you change it to fiat, that is when obviously there will be an implication. The problem is, what if you use that as payment? This is difficult. So I'll say this: SARS depends on you to be honest about your own cryptocurrency holdings and your cryptocurrency movements. So SARS is dependent on taxpayer honesty, taxpayer compliance. So if you do not tell SARS that you have disposed of some of your holdings in Bitcoin, and you use that to buy stuff on bid or buy or take a lot or wherever, you don't tell SARS, then you are basically committing tax evasion, to be quite frank. But SARS depend on taxpayer honesty, and that is, yeah, it's rough. I can understand why people won't be honest with SARS, especially, and why people like things like Bitcoin and cryptocurrency, because it's very difficult. So there will be a tax implication when you sell. It depends on whether you held the coins as an investment or as a share trader. And yeah, you will need to let SARS know that you've sold or used it to buy something, and that will trigger a tax effect. Excuse me. That's not COVID, by the way. Next live session must be a jam session. Yeah, maybe somebody else can bring some drums, and maybe we can do something online. Terence asks, do you feel Regulation 28 that applies to pre-retirement investments is a good or a bad thing? Explain your thoughts and views on this. Ugh. Okay. For those of you who don't know, Regulation 28 is, let me just check this quickly. What's the limitation on Reg 28? What's the, how much, there we go. So 45% in domestic exposure. Okay. Yeah, you see the problem with Reg 28 is when you force an investment portfolio to be in a particular country, you are technically bringing in a location risk, which means that most of your assets, your portfolio, is then focused on SA. Now, if you look at SA as an economy and compare it to other countries, SA is quite small compared to the other world economies. And so why would you, and so it makes sense that a part of your portfolio should be based in SA, but a little bit more should be based outside of, but quite a lot more should be based outside of SA, because simply the economies are bigger there, and also it's been proven many times that foreign holdings, and often if you've got foreign holdings, often those foreign holdings outperforms what basically happens in South Africa. And so Reg 28 is basically a limitation. It forces you to have a certain amount invested in SA. And I personally am not a fan. I think for certain people who want to be who want their investments dominated in SA, that makes sense. But I think the Reg 28 is a bit too much constraint on the investor. But that's just my opinion. I'm not a fan. But yeah, I don't know if my opinion on that weighs much. Krista asks, Sibongeleni asks, good evening, Andre. Does one include income received as a bona fide maintenance, including gross income? If yes, is there a deduction for it? Okay, that's a great question. Thank you. So, those are so bona fide means real or actual. So bona fide actual maintenance, and maintenance is obviously what a person might receive if they are divorced. It could also mean that if I've got a son who is dependent on me, or my wife, for example, whoever, I might pay them maintenance to keep up their living standard, for example. Mate, excuse me for the coughing. My son's got a bit of a anyway. Sorry, where was I? Maintenance, yes. Okay. Maintenance is a donation. So, and donation, and specifically bona fide maintenance, is a non-taxable receipt for the person receiving it. So so it is 100%. There is no taxes on that. You don't pay any tax on the maintenance that you receive, whether via as a result of a divorce or whatever the case may be. There's no tax on that. On the other side, there is donations tax implications if it's not maintenance. So if I gift to a friend 200,000 Rand, and that friend has not reached their limitation on the donations tax of 100,000, the first 100,000 would be exempt from donations tax, but the 100,000 beyond that will have a 20% tax implication, which means that the donor or the donee will have to pay 20% tax on the 200,000 they received, and so that's 20,000 Rand that must be paid to SARS. But that does not apply to bona fide maintenance. The last piece of advice I can give you is definitely make sure that the bona fide maintenance is written, that there's at least written proof that it is a bona fide maintenance. Just have physical proof as backup in case SARS might ask a question. Excuse me, you couch again, I tag this. If I cough again, coughing on live stream is not contagious. Okay, but that cough is cold now. Does a landlord need to be a provisional taxpayer even if a rental income is less than 10% of total income, say 5%? Okay. So provisional tax happens automatically. So if you submit extra income that is not pay-as-you-earn deducted, that will automatically fall into the provisional tax net. When your assessment gets issued, on the assessment, SARS will have a tick box circled yes, or it won't be circled, there will be just be a yes or no. If it says yes, then SARS considers you a provisional taxpayer, regardless of how much rent came in or not. So that's the important thing there. So Yeah, it does land. I think the safe thing. I think Mr. Dubin, the safe answer would be you have to be a provisional taxpayer. Make sure again set aside 10 to 20% of the rental income aside for tax purposes, and then you should be sorted. No problem there. Also, you have to submit your provisional taxes. If SARS considers you to be a provisional taxpayer, you have to submit provisional taxes. For those who don't know, if you're a provisional taxpayer, first provisional is 1st of August, second provisional is in February, and that's when you submit or pay your provisional tax. And provisional tax is a tax that you pay on top of the pay as you earn, and it covers all your non-pay as you earn income. Do you think there's a tax structure that SARS can deduce to help South Africans? Yes, there is. Yes, there is. This might sound dumb, but I'm thinking of the way to reduce income tax. We'd have more money to spend on. Yes. No, it's not a dumb question. I think one of the things that's frustrating to me is when you look at not donations tax. When you look at turnover tax, SARS brought in turnover tax in 2012, and and basically they said if your turnover is less than $1 million, then you don't have then you can register for turnover tax. However, it is limited to certain industries, and only certain industries can register for this. And basically, SARS have left it alone completely. They brought it in 2012. It's now 2021, and they haven't touched it since. Now, obviously, inflation changed. Income levels changed, a lot of things changed. So, I mean, why don't they update the turnover tax rules so that it can catch a wider net of businesses? Why don't they increase the turnover exemption to make it 2 million or perhaps 5 million? Because turnover tax is really a great tax system, and you pay a lot less tax if you fall into that particular industry. I think one move Tito Mboweni did right is they reduced company tax from 28% to 27%, and this is a great move. I hope to see more of that going forward. South Africa is taxed at crazy rates. We are taxed more than I think that we're the highest tax within the BRICS. So Brazil, Russia, India, China, and South Africa. I think those are the BRICS countries. South Africa has the highest, as far as I know, the highest taxes. And we've got an incredible amount of people leaving SA because tax is one of the main reasons. And it doesn't help that VAT went up because now, because VAT has impacted the poor the most, the low income, even your medium income persons are impacted the most by the VAT increase. And so, yeah, definitely lowering the income tax will actually increase people's willingness to pay tax until things improve politically, socio-economically. Yeah, so definitely I think there's scope for SARS and Treasury to reduce taxes across the board. Yassine Khan asks, are there donations tax on maintenance of parents? No, there's not. If you are maintaining your parents, if you're helping out them financially, they don't have to pay any donations tax. Neither does the donor. Neither do the donor have to pay any donations tax. Yeah, just make sure that a tax practitioner signs it off to say what you pay your parents is considered a bona fide maintenance. Let me just get the correct legislation for you, then you can actually use this. Then I can be of benefit. So let's see, donations, go down, section 18, exemption, so it's section 56, and then I go to maintenance. Okay, section 56, subsection 2C. Okay, let me put it in the chat. Bona fide maintenance ITA, section 56-2. There you go. That's a section. Make sure that the tax practitioner or yourself refers to the maintenance that you pay your parents to be in terms of section 56(2)(c) of the Income Tax Act. And then you basically have written proof that those donations will be tax exempt. Hi Andre, could one swap local stock for international ADR holding of same company without SARS seeing this as a sale and therefore avoiding the tax implication? Swap local stock. Okay, so you've got SS stock for international holding of same company. Okay, this is a complicated question, but be very careful of deemed disposals. This is really, really, really important. There's a literal Bible about capital gains tax and what can trigger what SARS sees as disposals. To me, I'm going to be on the safe side and definitely say, look at it. If you can't have a tax practitioner, somebody who deals with things like this, this is not the type of question that I often deal with, and make sure that it would not be deemed a disposal. In my opinion, a knee-jerk reaction would say, I think it's going to trigger a disposal event and trigger capital gains tax, but I might be wrong. Listen guys, I'm going to end this stream at 9 o'clock. So if you guys have any more questions, non-tax related as well, it's wonderful to have you all here. Thank you for those who's been chilling. Yeah, no, I'm going to reiterate what I'm saying. Get a tax practitioner who deals with these specific transactions, and ask them to write you an opinion. I do not have the capacity for such an opinion. I mean, I can spend some time, but it's a bit outside of my comfort zone, to be honest. Yeah, but I think it will trigger a capital gains tax event. So any more questions? Otherwise, I'm gonna end the stream off here if there isn't any more. Hey, another one. Neil Smith. Okay, hello Andre. I'm 20 years old. Hey, you're young. Great. Would a tax-free investment be the best investment for myself? Should I worry about the tax at this moment? I'm only starting, don't have a full-time job. First of all, Neil. Okay, everybody, I want you to congratulate Neil if you want to. You don't have to do it, but I'm going to congratulate Neil. Amazing. You are thinking about investments at like 20 years old. Amazing. Well done. Okay. If you do this, you'll make it. Okay. Tax-free savings account. The nice thing about being young is you will be able to reach the 500,000 maximum limit that you can transfer into the tax free savings account very early. You could reach it before the age of 35, which means that your growth trajectory after reaching the 500,000 will be so much more, because you're starting it at 20. Okay, so you'll reach that 500,000 limit. You'll still reach it within the time frame that everybody's given, but because you are young, people are pushing, and financial advisors push tax-free savings accounts for people that's young because they have time. Okay, people who are old, 50 plus. I'm sorry if you're 50 and I'm not 50 yet, and I don't know whether you feel old at 50. Anyway, sorry, I'm digressing. Okay, if you are 50, tax-free savings account is often not recommended. However, if you are young, tax-free savings account is. In terms of should you worry about the tax, I think it's important to consider tax as part of the whole, should I invest? Where should I invest? What should I do with my money? Okay. And consider tax as the third or fourth thing that you look at. The first thing is time horizon. Do I have a lot of time? And yes, you do. You are 20 years old. Number two is risk. How risk averse are you? So this can be, you can have this chat with a financial planner. You can do a lot of the homework yourself. But those two are things to definitely take a look at. Tax-free savings account is not that beneficial in its initial phase, and here's why. In its initial phase, number one, there might be an interest portion. Local interest already has a deduction of 23,800, or an exemption of 23,800. So there's already that exemption there. That's the first thing. The second thing is donations tax is going to be 20%. So, I mean, you can take the tax hit if you're not in a tax-free savings account. But listen, my suggestion from a tax point of view would be to, and this is to anybody, is if you are considering investing and you haven't considered a tax-free savings account, purely from a tax point of view, a tax-free savings account is a good product. It's a good investment from a tax point of view. Okay, max it out, and once you've maxed it out, whatever you do with the amount after that, if you've got money left over, then you can fly with it. Yeah, definitely. Long-term benefits of a tax savings account. I mean, no capital gains tax is amazing, because the thing is, I was doing Bitcoin stuff. I'm working on a video for cryptocurrencies. If you're selling a lot of Bitcoin and you bought back in 2020, back in 2013, your Bitcoin is going to be taxed at 18%. Now imagine your Bitcoin forms part of the tax-free savings account, and you don't have to pay any capital gains tax in there. Think about that for a second. Neil, you should, Neil, join Banker X on Telegram Live. Follow them on Twitter. Do that. What do you think of Frank? I've never used Frank before. Yeah, okay. This was fun, guys and girls and everybody in between, and the colors: white, black, colored, Indian, Chinese. I don't know, is there any Chinese in the chat? I don't think so. But thank you all for being here. I really appreciate that you've been here on a Sunday evening listening to me talking about tax. Have a great evening and good luck for this week. Okay. Cheers everyone.